and welcome to Hot Money on Bloomberg Quint Live, India's first digital live streaming business news service. This is a show which gives you a complete wrap of all the stocks that are buzzing in trade. I'm Darshan Mehta. Let's welcome our guests on the show. Joining us today are Sharmila Joshi, who is an independent investment advisor, Lakkar of Newberry Capital, and T.S. Harihar of HRBV Client Solution. Many thanks to all of my guests for joining me. On the show today, we talk about Interglobe Aviation and whether the friction between the promoters is any cause of concern for investors. We talk about the Bajaj twins, Bajaj Finance and Bajaj Finserv, or whether they are the best players in the NBFC space, because most of the NBFC stocks are down in trade. Both these counters continue to trade at record highs. Auto store sales will continue to be reported over the next few days. We discuss the expectation from the auto sector. Most of the numbers have come out. Some of them have been good, some of them have been bad. So we'll talk about what's the expectation from auto sales and whether any kind of uptrend can be anticipated. And finally, we talk about Whirlpool, and the counter has been doing well, whether the current valuation demand a buy or no. So that's the trend that we're seeing as far as most of the stocks is concerned. But we'll start with Interglobe Aviation. It has been seeing a lot of resistance that's coming in at higher levels of late. The counter to obviously the big promoter tiff is now out in the open. Can this be a cause of worry for Interglobe Aviation? That's what we ask our guests at this point of time. Hari, what's your sense? Nothing to do with operationals as such, but you know it's happening at a promoter level. Are you concerned with some? If someone's holding an Interglobe stock or wants to buy, should he be concerned about this development?
I wouldn't think so, because if you look at the differences between the two principal promoters of Interglobe, I don't think there's serious issues. I think apparently what has happened is over time, one of the co-promoters has had a larger say in things as far as the operations of Interglobe are concerned, and one promoter has had a smaller say. I think it's basically the promoter with the smaller say trying to get a larger say. So I think it's more of something they need to sit across the table, negotiate and sort out. I don't think it's a very serious structural issue between the two promoters where they are looking at separating or going their own way. I don't think anything of that kind. It's probably more about giving more say to one promoter who doesn't have as much as the other one. So I don't see that as a major issue. See, let's not forget that Interglobe today is an extremely sweet spot. Jet is out of the business. I don't know when it will come back. You have three other airlines which have a much smaller market share compared to them, and probably the biggest beneficiary of Interglobe of the Jet going out is going to be Interglobe, obviously, and the market share is already at about 43-44%. So I don't think there are any concerns, and I think if you were to buy an airline stock, my choice obviously would be Interglobe.
Interglobe. What about SpiceJet? Any view on that?
I'm not too positive on SpiceJet. I think that company is probably, unless they do a massive expansion of the fleet, and I'm talking about expansion outside of the 737s, because that is where most of the problems are. It's going to be very difficult for them to build market share, and they don't have the kind of balance sheet muscle which Indigo has to get more planes, expand the fleet capacity, etc. So I think for them it can be a lot more laborious. The real beneficiary of quick gains could be more actually Indigo.
What's your sense, Sharmila? Is it a matter of concern when promoters, there's a tiff between promoters, or it's negligible now?
Oh, well, honestly, if you look at the kind of shareholding both the promoters have, it's substantial. So, I think in that sense, they both have enough skin in the game to not really rock the boat too much. And again, as Hari was saying, that the jet issue has meant positive things for the rest of the airline space, and we've seen in the numbers. Very honestly, I think probably Interglobe did benefit, but in terms of market share, I think probably SpiceJet benefited more than Interglobe, and the other domestic play gained more due to this jet exit, and we don't know whether Jet is really going to make a re-entry or not, and Interglobe going forward could benefit more from the international market if they get some of those slots, etc. So that remains to be seen. But honestly, I would be concerned because, I think the way things have played out, especially in the Indian market in the last 4-5 months, they've not been good. And yes, I would wait to see a resolution, because, the stocks have had a run-up because of the jet issue, and now the valuations are on the higher side. So I wouldn't make a fresh entry. So there does seem a low chance at this point in time that this could get worse, but I would still wait for it to be resolved, because, very honestly, I think even if you look at business graphs of a lot of companies, what you observe is that when things are tough and when you're trying to build the business, people sort of stay together. And when you get onto that level where you say, okay, now, where you actually need to push for the next level, that's when the differences start cropping up. So this is a worrying time as far as I'm concerned, and I would wait to see a resolution.
Okay, is that something that you would agree? Is it of concern for an Indigo shareholder?
Not really. I think I would go with Hari's view that it's not so structural, and the airline is still run by an independent CEO, and I think they have demonstrated their capabilities. I mean, building an airline, having a 45% market share over just a period of say about 13-14 years. I mean, it's commendable what they have done. So there would be some issues. I mean, I don't think the airline has clarified as yet officially, but the media report says that the issues are relating to some policy or some control or something. But I think that can be ironed out. They have also appointed, I think, independent law firms to arbitrate on the issue. So let's not speculate too much into that. Let's. I mean, I would evaluate Indigo as a separate business, how it's doing. And as an airline business, I mean, the most important thing to evaluate is the cost structure. Now, Indigo's cost structure is comparable to the best of the airlines worldwide, whether you compare it to a Ryanair or whether you compare it to a Southwest. They have a significant market share. The runway for growth in India is massive. I mean, if you compare the under-penetration that we have, the traffic growth has been 16.5% over the last 5 years. And the interesting bit in aviation industry is adding capacity is not so easy. Even if you plan to add a capacity today, it will take at least 3 to 4 years time to actually come it on stream. So it's not as if some big player comes into this foray and he can immediately build his capacity. So Indigo's capacity is the largest, and they have the largest order book as well. So I think a combination of robust demand growth with the best of the cost structures and with this capacity getting added makes Indigo a clear winner. Having said that, the stock has rallied a bit, and this is a space where it is subject to crude price fluctuations. So you will get frequent air pockets. So that's the time to chip in and accumulate.
Have you been recommending your clients to start accumulating Indigo, or you've told them to stay away from aviation as such?
I haven't said stay away, but that's what I'm saying. So wait for that air pocket to come in, either from a crude shock or even from this promoter-related shock if it comes.
Buy on declines.
Buy on declines.
Okay, that's the view that's coming in on Interglobe Aviation and the aviation space. The second one is interesting. Two stocks which continue to trade at record highs when the entire sector is bleeding. You saw the entire NBFC sector, be it a Dewan Housing or be it a Piramal Enterprises, all of them are seeing heavy selling that's coming in. Indiabulls Housing Finance, one of the other one. But two stocks which continue to shine high, Bajaj Finance and Bajaj Finserv. Obviously, Bajaj Finserv gets a lot of valuation from Bajaj Finance itself, apart from the insurance business that it has. But nevertheless, they continue to rule the roost. Valuations now trading at record highs. What should one do? Should money be again poured into these quality NBFCs where valuation is high, or take a bet from the NBFCs which have fallen significantly and valuations are now attractive? Sharmila, what should one do? Bajaj Finance Twins, does fresh money deserve to be put on these two counters?
Well, if you want an exposure to NBFCs, I think yes. For the simple reason, one is what you were alluding to, one is an insurance business, and that sort of grows steadily. We've seen that, and I think that's the way Bajaj Finserv, for instance, has grown their insurance business. It's been good, and I think they're on a very good sort of attraction, and the way their AUMs etc. are increasing has been very commendable. Coming to finance, again, I think they've done a great job because, I think that they have realized very early on in the game that some of these NAVs, etc., that can hit you in the kind of financing that they're doing could become worrisome. And so they've had a very granular approach to the business. And that, again, is something that is still giving very good numbers. And, the kind of problems that NBFCs have had so many, whether it is corporate governance or whether it's what's happening with the housing finance companies, they seem sort of out of that gamut at least. So I think from that perspective, again, it's a safe bet, safer than the rest at least. So if you want an exposure to NBFCs at this point in time, then to my mind, they are among the best stocks that you can look at. And also, again, that's sort of been the mood market has been in, where really we've seen the buying shift to these top 15 or 20 stocks pretty much. and a lot of FI money has flown there, and that's for a good reason. So I think that premium valuation will continue.
Anything on the NBFC space which has fallen significantly, but you believe that the corporate governance is proper, the valuation is proper, it ticks the other boxes except for the price fall?
Well, honestly not, because I think everything has had some issues. Like, we spoke of Equitas and Ujjivan in our last show. So, that has its own set of issues. I think the gold financing business is another decent spot, but we've had that whole Mannapuram, whatever, that price sensitive information, story that did the round. So, I think it's best to, then you have really HDFC. So, that's what you're left with then.
But it doesn't fall in the price correction because it hasn't corrected that much.
Exactly.
Sangeet, what's your sense? Are these two the best play? Valuation obviously is expensive, but if someone wants to make a fresh investment, is it something that they should look at?
So I wouldn't buy at the current price. I mean, I've been proven wrong time and again on this. I mean, I found it expensive at 6 times book, more expensive at 8 times book. Now it's already, I think, 10 times book. But I still find it expensive. I think the problem pocket in the NBFC has been the real estate and the housing finance space. Now this particular franchise has its exposure in the consumer finance. We are yet to test this business model in a consumer finance down cycle. We haven't seen one yet, so I think for me that is important cycle to play out. The valuations look stretch. Even though it's at 10 times, I still feel that the re-rating from here looks unlikely. I would rather go for the turmoil sector, which is the housing finance, and choose the leader out there, because that's where you will see the incremental market share being captured. The more market share coming in, the more pricing it has in terms of the asset quality, in terms of the size. So I'll stick with HDFC if I have to compare it with the Bajaj Finance.
Okay, so I think both of our guests do believe HDFC is something that, apart from the Bajaj twins, is something that you need to watch out for. Hari, what's your sense on the entire space of NBFCs and Bajaj Finance and Finserv?
No, broadly I agree that Bajaj Finance again is a go-to stock if you want to buy an NBFC stock or a consumer finance stock. And with the problems that we had in the recent past and with the latest SEBI regulations which puts serious restrictions on mutual funds putting money, I think a lot of these so-called names like Dewan Housing are going to have a serious problem getting funds in the market. So the differentiation between a Bajaj Finance and other finance companies is only going to get a lot more acute in the coming months. So that should probably work in favor of Bajaj Finance. But having said that, I still think somewhere the rationalization of valuation has to come, because 10 times book, 63 times price earnings. I think it's a little too steep for someone to commit serious money. So I would be a little skeptical of serious money. Where do you put the money in NBFCs? See, clearly stocks like Dewan Housing are out. I think there are too many questions at this point to answer, so we stay off them. I think there are stocks like LIC Housing and GIC Housing where we see a much lesser risk quotient at this point of time. They don't have this huge maturity mismatches that some of these private housing finance companies have, and they have the backing of a very, very sound institution. So probably if you ask me which finance company I would pick, I would probably pick an LIC Housing or a GIC Housing at these places. Okay,
that's the view that's coming in on the NBFC space. The next one is the auto space. In which again the monthly numbers for June have started coming out. Maruti came out with numbers which was disappointed. Ashok Leyland disappointed with numbers. Bajaj was pretty much in line. So all across the board, but the auto sector seems to be doing well. It's up 1.4%. Eicher commercial vehicles didn't do well in trade. But what should one do in the auto sector? Have the auto sales numbers bottomed out, or is there more traction? Are valuations now attractive enough to buy? What's the sense? Sangeet, I'll start with you. Anything in the auto space that you've recommended to your clients recently based on valuation or some other parameter that you've used to value them?
So not in the OEM space. I just like some tire stocks to nibble in. I think there is more downside in the OEM space. So it's a difficult business. I mean, we have seen valuations of Maruti correct by around 20-30 times, but despite that, it is one of the most expensive valued stock if you see globally. The reason being they have to churn out new models, and that comes at a cost. And the shelf life of models is reducing, year by year. In the 90s, we saw the Maruti, the 800 was, they sold for about 10-15 years. Now that shelf life is going to come down in future, I like few tire stocks. Again, it's just because of the valuation being reasonable. But as such, I'm cautious on this space. It's ripe for disruption. You're going to see a big BS6 transition. You're also going to see a big electric vehicle transition. So we'll have a lot of new players emerging in this space. The older ones might get weed out. So we'll have to be a little cautious.
Are you liking the tire space because of the replacement market? Because if you're not bullish on the OEM market, it means that you must be playing this theme. And which valuation-wise, which tire stock is looking attractive?
So again, I would go with amongst the passenger vehicles MRF. As you rightly mentioned, the replacement demand should be strong. Also, it is less susceptible to the disruptions, whether in terms of BS6 or whether in terms of electric vehicles. I mean, you'll need tires in any case. So it's a little stable kind of stock. Again, not the bottom of the cycle, but it is at least at a down cycle. Okay,
Sharmila, is that the sense you have being cautious on this sector, or you started telling your clients to start buying auto stocks?
No, I'm extremely cautious on the sector. Okay. And you know, just to take off from what Sangeet was alluding to, you had a point where you were giving them very, very fancy valuations, and with good reason, because you were getting those kind of sales numbers month on month in the Indian context. But we have really seen the picture turn extremely, I would say, bad in the last couple of quarters. And very honestly, I think even some of the managements, when they were interviewed, have been hard. I mean, you know, they have not been able to really pinpoint the reason why sales have fallen quite so much. And this has come after 10 or 12 years of, you know, the kind of growth that we've seen. So you've seen Maruti correct all the way, whatever, and Maruti has also announced they're going to get out of diesel cars. So, you know, that could be even slower sort of to grow. Plus this whole replacement of models issue, plus BS6 norms coming in. So that would mean you can't carry forward that inventory. So even if you see an improvement in the next couple of quarters, month on month, you could start seeing numbers stabilize and start seeing them sort of average out month on month. The margins will still be under pressure. So I think you're going to have to give it a slightly lesser valuation for some time to come. And then within that space, I think Bajaj Auto, for instance, has already sort of shown that they were a little ahead of the curve in sort of predicting that this slowdown would come, and that is why they positioned themselves, and which is why I think, you know, even as on this month, their numbers are sort of okay to look at. So, and I think the recovery will come in the two-wheelers first, and probably the last will be the CVs, because that's a very sticky space. Okay. So once you start seeing numbers improve there, then they stay improved for 2-3 years, you know. So that's a very sticky space. So to get there, I think is another couple of quarters away. So probably people will start buying when they start seeing the month-on-month numbers get improving. But I think we are still to even see that.
Okay, Hari, is that something that you also agree that there is pain left?
Yeah, I think there's a lot of pain because, you know, if you look at the latest inventory numbers, I think the inventory numbers for all these guys are huge. Now, you know, with BS6 coming in next year, you know, there's going to be a big pressure on all these companies to get rid of their inventory in the next 1 year. Now, that would mean that over the next 12 months, you could see production actually getting compressed. You know, most of these auto companies are going to focus purely on getting rid of the inventory and then look at production. So, almost every month you could see a 10 to 15% contraction in production, and that would mean lower sales, and lower sales growth has never been positive as far as valuations are concerned. So I think I would probably give up on autos for the next 1 year. There's another problem, which is financing. I think with the NBFCs in crisis, cost of funds going up, you know, hopefully unless there are the 2 or 3 more reductions by RBI and the cost of funds comes down by another 80-100 basis points, I don't see any chances of a revival as far as auto is concerned. So we are off auto. I would agree with Sharmila that you know, something like a Bajaj Auto with a very strong export franchise in the two-wheeler space, entry-level market, I think that has a better chance of doing well compared to any of the four-wheelers.
Okay, that's the way that's coming in. I think overall cautious views remains on the auto sector. Select stocks, at least in the tire space, is what Sangeet does believe. Two-wheelers like a Bajaj Auto probably may recover much faster than the others, is something that the other guests are speaking about. And one stock we want to talk about finally is Whirlpool. It's been doing well in a market which hasn't done well. I don't know what the counter is doing today. Today it's absolutely flat in trade, but what's the view on Whirlpool going ahead? I'll start with you, Hari. Any sense on Whirlpool?
Not a very, I think, I would say interesting stock. If you look at the price range of the stock, it's about, I think, 5% higher and 5% lower from the current price. So not a great mover as such. But we have had a worry about most of what we call the consumer discretionary space, especially the consumer durables, because that is where, if you look at the latest Credit Suisse report on consumer durables, there has been a huge tendency among Indian consumers to postpone durable buying decisions, and that has taken a toll not only on autos but even on consumer durables, the FMCG segment. The second thing I have a worry about Whirlpool is that Whirlpool is a company that has an operating margin of around 11 to 11.5%, but has a PE of around 56. So, I can understand a food company like Hindustan Lever, which gets a PE of 50, 55, but then a consumer durables company with a operating margin of 11% getting a PE of 55, I think is a little too steep. So, I think the stock seems to be overpriced. Probably there is a little too much being written about the stock, and I would probably advise people to keep out of the stock at these prices.
Okay, keep away. Sharmila, what's your sense on Whirlpool?
Well, I don't have a recommendation in terms of a buy, but I think it's a very interesting play. And the reason I say this is that, the kind of products that they have, I think they've positioned themselves very cleverly. So on the one hand, for like a rural sort of a market, they have, those one-door refrigerators and semi-automatic washing machines, which do well in semi-urban and, rural kind of areas. There is a general preference for those. And then they're also positioning themselves by having something like an electric, what are they called, the chimneys, and they have air purifiers. And, these are like the new product ranges that you can talk of, front-loading machines and etc., etc. And they have actually increased their presence. They've increased their network. So that I think that's another very big positive. So they have a good product line. They have a good network. Numbers have been decent, and like the management is also sort of confident that they'll deliver in the coming year as well. So I don't have a recommendation, but I think it's a fairly good play in the consumption basket.
Okay, what's your sense, Sangeet? Whirlpool or some of these consumer durables?
So again, expensive. I mean, that's the one-word answer. So it had a significant run-up till FY18, but last 1 year we have seen a significant time correction also. So I think that is still more to go in that. The valuations again trading at 50 times, whereas the earnings are growing at close to about 15 to 18%. So we have to balance out the two. I think it's a too high valuation to pay for this company. And it's a competitive space. I mean, especially with the likes of online distribution coming. So you will have newer player, you will have Chinese, Korean, all kind of players who are coming in, because the distribution part of business gets challenged, where Whirlpool was so strong up till now. So I would wait for a fair correction to buy into the stock.
Okay, that's the view that's coming in. I think valuation's too expensive for some of the consumer durables name. But with that, it's a wrap on today's edition of Hot Money. Let me thank my guests for coming in, Sangeet, Sharmila, as well as Hari. Thank you so much for coming in today. Ask BQ comes up next. Stay tuned to Bloomberg Quint.